and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Yeah, it's great to have you here. We're diving into a topic that's super important for anyone in real estate: when to sell your rental property.
Exactly. It can be such a tough decision, right? Knowing when to hold on and when to let go. That's what we'll explore today.
Absolutely. We'll talk about the signs that indicate it might be time to sell and how to evaluate your property's performance.
And we'll also touch on some strategies to maximize your returns, along with the emotional side of making that decision.
Yeah, it's not just about the numbers. It's also about what feels right for you and your long-term goals.
We'll share some real-life examples, too, so you can see how others have navigated this tricky terrain.
That's right. So whether you're feeling uncertain or just curious about the right timing, stick with us as we unpack this topic together.
Let's jump right in. So, Mike, what are some of the primary indicators that it might be time to sell a rental property?
You know, Sarah, when we talk about selling rental properties, it's not just about numbers on a spreadsheet. It really ties into where someone is in their life, especially for folks over 40.
Absolutely. I mean, at this stage, a lot of people are starting to think about retirement, or at least what that will look like for them.
Right, and with that comes the realization that the decisions they make now can either set them up for a comfortable retirement or create more stress down the line.
Exactly. And with inflation being what it is, it's a real concern. Owning property can be a hedge against inflation, but sometimes selling at the right time can also be a smart move to protect your wealth.
For sure. I remember working with an investor named John. He was in his early 50s and had several rental properties. He was feeling the pinch of rising costs, and he realized that holding on to all those properties meant more expenses: maintenance, property management fees, you name it.
That's a great point. So what did he do?
Well, he decided to sell one of his properties, a duplex that had appreciated significantly over the years. He was able to cash out on that equity, which, allowed him to pay off some debt and invest in a more manageable portfolio.
That sounds smart. It's like he was trading some immediate financial pressure for long-term peace of mind.
Exactly. And it's a common scenario. People often forget that selling can be part of a solid strategy. It's not just about buying and holding forever.
Right. And the market shifts we've been seeing lately, they can really impact when and how we should sell.
Yes. The current economic climate is volatile, and that affects property values. For instance, if someone's in a hot market right now, they might be sitting on properties that have increased in value much more than they expected.
Like the story of Linda, who lived in a suburb that suddenly became trendy. She had no idea her rental would skyrocket in value.
Exactly. She was holding on to it for the long term, but realized she could sell and take advantage of that market shift. She ended up selling, and the profits allowed her to invest in a vacation home while also setting aside some for retirement.
That's amazing. So it's not just about selling because you're tired of being a landlord. It's about recognizing opportunities that can enhance your lifestyle and financial security.
Absolutely. And I think that's a huge part of it: emotional security. For many people over 40, it's not just about the money. It's about feeling secure in their financial future, especially when considering wealth transfer to family.
Oh, definitely. It's common for people to want to leave something behind for their kids, right?
Exactly. And sometimes selling properties now can provide a financial cushion that allows for better planning. Like, if you sell a property and use that equity to fund a college education for a grandchild, you're not just selling, you're investing in your family's future.
I love that perspective. It's about using your assets to create opportunities for the next generation.
Yes, and with the current economic trends, like interest rates and housing supply, it's crucial to be adaptable. For instance, if someone isn't seeing any cash flow from their rentals because of rising interest rates, it might make sense to sell and reinvest.
That's such a practical approach. So what are some signs that someone should consider selling?
Well, one big sign is if you're feeling overwhelmed by the management of the property. If it's causing more stress than joy, it might be time to rethink it.
That's so true. And what about the emotional factors?
That's a huge aspect too. If you're constantly worrying about the property, it can take a toll on your overall well-being. The peace of mind that can come from selling and simplifying your portfolio is invaluable, especially at this stage in life.
It's like freeing up mental space, right?
Exactly, and it's also about aligning your investments with your personal goals. For someone who's nearing retirement, having liquid assets can be a game changer, especially in uncertain times.
And with the cost of living going up, having that liquidity can help manage unexpected expenses or even just enjoy life a little more.
Yes, I've seen investors who sell properties and then use that cash to travel or invest in experiences that bring them joy, instead of just holding on to something that doesn't serve them anymore.
That's such a refreshing way to look at it. It's not just about the real estate, but about enhancing your life.
Exactly. And remember, it's also about timing. Sometimes the market may not be in your favor, but if you've got a good reason to sell, like personal circumstances or changes in your financial situation, it can still be the right choice.
So it's really about weighing all those factors: market conditions, personal goals, emotional well-being, and financial security.
Right, and knowing when to let go. Now that we've explored why this matters, I think we can dive into some core strategies for deciding when to sell your rental property. So when we think about selling a rental property, it's really important to have a clear strategy in mind,
Absolutely. Like, what are some of those core strategies to consider?
Well, one of the first things I'd suggest is to look at the property's performance over time. The classic 1% rule is a great starting point.
Right. The 1% rule. That's where your monthly rent should ideally be at least 1% of the purchase price, right?
Exactly. So if you bought a property for $200,000, you'd want to be getting around $2,000 a month in rent. If you're way off that number, it might be time to reevaluate.
That makes sense. And if you're not hitting that 1% target, does it mean you should sell?
Not necessarily, but it's a red flag. You need to dig deeper. Look at your overall cash flow, expenses, and whether the property is appreciating in value.
So it's not just about the rent. What if the property has been a bit of a money pit?
That's where the 50% rule comes into play. This rule suggests that about 50% of your rental income will go toward expenses, maintenance, property management, taxes, all that jazz.
So if you're bringing in $2,000 a month, you might be spending around $1,000 on expenses?
Right. If those expenses are creeping up, or if your cash flow is really tight, then it might be time to consider selling.
And what about cap rates? How does that factor in?
Great question. The cap rate, or capitalization rate, is a way to evaluate the potential return on an investment property. You calculate it by dividing the net operating income by the property's purchase price.
So if your property's net operating income is $20,000 and you bought it for $200,000, that's a 10% cap rate?
Exactly. A higher cap rate usually indicates a better potential return, but also can mean more risk. If the cap rate is lower than what you see in your local market, it might signal that it's time to sell.
Got it. So if the numbers aren't adding up, it's worth looking into your options.
Right. And also think about your long-term goals. Are you looking to retire soon? If cash flow is tight and you're nearing retirement, it might be better to sell and invest in something that offers a better return or less management hassle.
That's a really solid point. It's not just about the numbers. It's about aligning with your life goals too.
Exactly. And here's a simple checklist for evaluating a property before deciding to sell. First, assess your cash flow. Then look at your cap rate, evaluate the local market trends, and check on your equity position.
So if the market is appreciating and you have good equity, that's a good sign to hold, right?
Yes, unless you're facing those rising expenses we talked about. But if the market is declining and you're not getting good returns, it might be time to make a move.
And what about financing options? How does that play into the decision?
Financing is crucial. If you're carrying high interest debt on that property, and it's eating into your cash flow, you might want to consider selling. You could pay off that debt and invest in a better performing asset, or even pay down your primary residence.
That's a smart strategy. And what if someone is considering a 1031 exchange?
Good point. A 1031 exchange allows you to defer paying capital gains taxes when you sell a property, as long as you reinvest the proceeds into a similar property.
So that can be a way to upgrade your investments without a huge tax hit?
Exactly. But you have to be careful to follow the rules and timelines. It's not for everyone. but it can be a great strategy if you're looking to transition to a better property.
Wow, there's a lot to consider. What about the types of properties? Are there certain types that are more beneficial to hold on to?
Generally, single-family homes tend to be more stable in value, while multifamily units can provide better cash flow. If you have a multifamily unit in a good location, it might be worth keeping even if the cash flow isn't perfect.
That's interesting. So location is key, right?
Absolutely. If your property is in an area that's seeing growth, maybe new jobs, schools, or infrastructure, that's a big plus.
And if it's a declining area, even if the numbers look good, it could be time to sell.
Yes, exactly. You want to be proactive, not reactive.
So to sum it up, you're looking at your cash flow, cap rates, market trends, and your personal goals when deciding whether to sell.
100%. And remember, it's not just about the financials. You've got to consider your time, energy, and future plans.
That's a great perspective, Mike. But are there common pitfalls to watch out for when making that decision?
Oh, definitely. Let's dive into those. So, Sarah, one of the biggest pitfalls I see investors fall into is over-leveraging.
Yeah, that's a big one. It can feel tempting, right? You see a property you love and you think, I can stretch my budget a little.
Exactly. It's like, the allure of that shiny new property can cloud your judgment. I had a client once who bought a duplex, thinking they could manage the mortgage while also covering renovations. But they didn't factor in all the extra costs.
Oh no! What happened?
Well, they ended up with a bad tenant in one unit, and that's when the financial strain really hit. They were already stretched thin, and then suddenly they had to cover both the mortgage and repairs.
That's tough. It's like a domino effect.
Right. And when you're over-leveraged, any little hiccup can become a major crisis. You really need to be careful about how much debt you're taking on versus what you can realistically manage.
Absolutely. So, what's your advice for someone trying to avoid that?
Well, I always recommend having a solid cushion, a buffer, if you will. Like, if you can, save up a few months worth of mortgage payments and maintenance costs before taking on a new investment. That way, if something goes wrong, you're not scrambling.
That makes sense. So, kind of like having an emergency fund, but specifically for real estate?
Exactly. And then, there's the issue of bad tenants, which can really turn your investment into a nightmare.
Oh, for sure. I think everyone has heard a horror story about that.
Yeah, I remember another client who, they didn't do their due diligence on tenant screening. They were just excited to fill the place.
Oh, no? What happened?
They ended up with a tenant who, let's just say, didn't pay rent consistently and caused damage to the property. It took months to evict them, and by then, they had lost a significant amount of income plus repair costs.
That's heartbreaking.
It really is. And the thing is, if you take the time to properly vet tenants, check references, employment history, you can often spot red flags early on.
Right. Like if their previous landlord says they were always late on rent.
Exactly. Or if they have a history of evictions. Those are major red flags.
So it's worth investing the time up front to avoid a bigger headache down the line.
Definitely. And then there's cash flow, which is like the lifeblood of any rental property. A lot of new investors ignore it, thinking, I'll just increase rent later.
Yeah, that can be a mistake. What do you see happening there?
Well, I had another client who bought a property in a neighborhood that seemed like it was on the upswing. They thought they could charge a premium rent, but they didn't account for the fact that the local market was actually pretty saturated.
Oh no.
They ended up with negative cash flow because they couldn't find tenants willing to pay what they had projected.
That must have been frustrating.
For sure. And it's so important to do thorough market research. Look at comparable rentals in the area. Understand what tenants are willing to pay and make sure your cash flow is sustainable.
And what about those hidden costs?
Ah, yes. That's another sneaky pitfall. A lot of investors don't realize how many unexpected expenses can pop up.
Like what?
Well, things like property taxes, insurance, maintenance, and repairs. A common mistake is to just look at the purchase price and mortgage, but not consider ongoing costs.
Right. I've heard people say, oh, I'll just budget for the mortgage. And then they're blindsided by all the other bills.
Exactly. I had a friend who bought a property thinking it was a steal, but shortly after they were hit with a huge property tax increase.
Yikes.
Yeah, and they hadn't budgeted for that. Suddenly, their cash flow was tighter than they expected.
So it's really about getting the full picture, huh?
Absolutely. I always tell my clients to do a thorough financial analysis before buying. Look at all potential costs, and then add a little extra for surprises.
Good advice. And then there's the whole timing the market thing.
Yeah, that's a tricky one. Many people think they can perfectly time their sale or purchase based on market trends, but that's so hard to predict.
Totally. I mean, the market can shift overnight.
Exactly. I knew an investor who sold their property thinking they were cashing out at the peak. But then, a few months later, the market took a downturn, and they realized they could have gotten a lot more if they had held on just a little longer.
That's a tough lesson.
It really is. And the best approach is to focus on your long-term strategy rather than trying to chase the market.
Makes sense. So what do you suggest for someone who's already made these mistakes?
Well, first, don't panic. It's a learning opportunity. Identify what went wrong, and then reassess your strategy.
Right. And maybe consider reaching out for advice?
Absolutely. Consulting with an experienced investor or advisor can help you get back on track. And if you're still in a tough spot, sometimes it's worth considering selling the property, but only after doing a thorough analysis.
Sounds like a solid plan.
Yeah, and remember, learning from these experiences is what makes you a better investor in the long run.
Definitely. It's all about growth, right?
Exactly. And with that mindset, you'll be better equipped to make informed decisions moving forward.
Great insights, Mike. I think we've covered a lot of ground here.
Yeah, it's been a great discussion.
So, what's next for our listeners?
Well, I'd say take a moment to reflect on your own investing journey and maybe jot down a few lessons learned.
That sounds like a good idea.
And then think about your strategy moving forward.
I like that. It's all about being proactive.
Right. And look out for those red flags.
Absolutely. Always stay informed.
Exactly. And with that, let's wrap up this segment.
Thank you all for tuning in. We hope you found this helpful.
Yeah, and remember, you're not alone on this journey.
Until next time.
Take care. So, as we dive into the next steps and tools you can use today, let's talk about what you can do right now to get started on evaluating your rental property situation.
Absolutely. I think it's important to remember that you don't have to do everything at once. Just taking one step can make a big difference.
Right. So one of the first things I'd recommend is to, start analyzing your current properties. Take a good look at their performance. You can use tools like the Bigger Pockets calculator to assess your cash flow, ROI, and other key metrics.
Oh, I love that tool. It's super user-friendly too. And if you're not familiar with it, just, spend a bit of time playing around with the features. It's really eye-opening.
Exactly. And if you're considering selling, it might be a good idea to check your property's current market value using Zillow. Just input your address and see what similar properties are going for in your area.
And don't forget to look at local sales data. A lot of times, you can access that through your local MLS if you have connections there. It gives you a better insight into the real estate trends in your neighborhood.
For sure. And if you're thinking about pricing your property right, Rentometer is another handy tool. It helps you understand the rental prices in your area, which can give you a solid baseline for evaluating your own property's rental income potential.
That's a great point. Plus, it can help you decide if you should increase rents or maybe consider selling if the market is favorable.
Yeah, exactly. And if you're feeling overwhelmed, just start small. Maybe set a goal to analyze one deal per week. Just one. It doesn't have to be a huge time commitment.
That's such a realistic approach. You could even join a local real estate meetup. Connecting with others who are in a similar situation can be really motivating, and you might pick up some valuable insights.
Definitely. Networking can open doors you didn't even know existed. Plus, you might find mentors who can guide you through the process of deciding when to sell.
And there are some fantastic books and podcasts out there, too. Have you read the book on rental property investing by Brandon Turner, Mike?
Yes, I have. It's a great resource. It breaks down everything in a way that's easy to digest. And I'd also recommend looking into podcasts like Bigger Pockets Podcast. They cover a wide range of topics, including selling properties and market trends.
Those are solid recommendations. I think it's really about building that foundation of knowledge, right? The more informed you are, the better decisions you can make.
Absolutely. And remember, every little effort counts. You might start by just listing out your properties and their current performance metrics. That simple act can give you clarity on whether it's time to hold or sell.
Yes. And don't hesitate to jot down your observations as you go. It can be really helpful to see your thoughts in writing. Plus, you could even create a checklist of things to assess for each property.
That's a smart idea. You could have items like current cash flow, market trends, and property condition on that checklist. It'll help you stay organized and focused.
And if you're looking at selling, it might be useful to start thinking about the timing. You could track seasonal trends in your area to see when properties tend to sell well.
Exactly. Some markets have, specific peak selling seasons. Understanding that can help you time your sale for the best outcome.
And don't forget about the emotional side of things. Selling a property can be a big decision, so take your time to reflect on what you really want.
Very true. Make sure you're clear on your goals. Are you looking to reinvest that money, or are you just ready to liquidate? That clarity can guide your next steps.
Right. And if you find yourself feeling stuck, consider reaching out to a real estate advisor or a mentor. Sometimes just having a conversation can spark new ideas.
That's such a good point. A fresh perspective can be invaluable. So, with these tools and steps in your pocket, you're ready to move forward.
Yeah, and remember, starting where you are is totally okay. Everyone has to begin somewhere.
So those are some practical first steps. Now let's bring this all together. Well, Sarah, as we wrap up this episode, I think it's important to highlight some key takeaways about when to sell your rental property.
Absolutely, Mike. So, first and foremost, knowing your market is crucial, right? Timing can really make a difference in getting the best price.
Exactly. And then, it's all about understanding your financial goals. If your property isn't aligning with your long-term wealth building strategy, it might be time to consider selling.
Right, and we talked about the importance of cash flow too. If your rental isn't generating the income you need, or if repairs are piling up, that can be a sign that it's time to move on.
Yeah, and don't forget about the emotional aspect. Sometimes it's just not worth the stress anymore. If managing that property is draining you, it might be time to let it go.
Such a good point, Mike. It's all about finding that balance between emotional and financial decisions.
And looking at the bigger picture of your wealth building journey. Remember, real estate is a long-term game. Each decision you make should support your overall strategy.
Definitely. And for our listeners, I hope you feel inspired to take those next steps, whether it's evaluating your current properties or considering new investments. Building wealth through real estate is totally achievable, especially if you stay informed and proactive.
If you enjoyed this episode, please take a moment to like and subscribe. We'd love to hear from you too. What's your biggest takeaway? Or maybe you have a question about selling your rental.
Yes, comment below or share this episode with someone over 40 who's thinking about investing in property. It might really help them out.
And next time, we'll dive into 1031 exchange mistakes to avoid. It's going to be packed with valuable insights.
Can't wait for that. Thanks for joining us today, everyone.
Take care and happy investing.
Bye for now.